Hi, everyone, and welcome back to the Finance Z podcast. Today's guest is Mark Dzialga, founder and managing partner of Brighton Park Capital, a leading growth equity firm that has scaled to nearly 4 billion in AUM since its founding in 2019. Brighton Park invests in entrepreneur-led growth stage software, healthcare, and tech-enabled service companies. Before founding Brighton Park, Mark spent over 20 years at General Atlantic, where he chaired the investment committee and helped expand GA's footprint across Europe, Latin America, India, and Asia. Earlier in his career, Mark was co-head of the Technology M&A Group at Goldman Sachs. In today's conversation, we'll dive into why Mark left GA to build his own investment fund, how he's navigating the so-called SaaS apocalypse and AI revolution, the race between OpenAI and Anthropic, if AI will spur new jobs, how AI is creating more work, and how we should utilize it given its efficiency, what revenue durability really means today, and his advice for the next generation of investors trying to break into the industry. Lastly, the views and opinions that Mark shares on this podcast are his own and do not necessarily reflect the views of Brighton Park Capital. Nothing discussed today should be taken as investment advice or an offer or solicitation with respect to any securities. Any topics discussed today are for illustrative purposes only. So without further ado, let's get into it. All right, Mark. I am so excited to do this with you. So thank you so much for coming on. Welcome to the show.
Great. Thank you, Logan, for having me. And congratulations on your graduation.
Oh, thank you. Thank you so much. Well, Mark, I kind of wanted to go back in time a little bit more about your career, early life. You spent 20 years at General Atlantic. You chaired the investment committee for a very long time, and before that, you were an investment banker at Goldman, leading the tech M&A group. And I was very curious because I also heard your podcast with RJ, and I wanted to dive deep into how did your early career and life, talked very highly about your mother as well when you were growing up. I guess how did it shape the way you think about risk, governance, and building?
Yeah, I would say there were many, formative experiences. My formal training was as an accountant. I worked at what is now KPMG for a couple of years, and you learn intense analytical rigor skills about how to analytically review financial and operating data. At Goldman, you quickly learn that you are far from the smartest person in the room,
Mm,
and it's a very humbling place. But the most important thing you probably learn is an incredible work ethic, where you're working 7 days a week,
yeah.
15 hours a day, and how to be a great professional, and attention to detail, precision, intellectual rigor, how to give great advice, like really explain to people what their alternatives are, and let them pick. But just being a great strategic advisor. And I also say at Goldman, you had to be a gadfly on everything. You had to have the ability to talk about a software company one day and a semiconductor company the next day, and a hardware company the day after that. And so just being a bit of a jack of all trades. And then at General Atlantic, it was about risk taking.
Mm,
It was the first time I was in a risk taking job. And I think the ability to define a risk corridor and to really believe in people, believe in a strong innovation and an important trend with immense secular tailwind behind it, and to get comfortable that it's not about what the company is, it's about what the company could be. And
yeah.
so those would be the three sort of general categories of learnings along the way.
And I think it's always interesting kind of how you go from the sell side to the buy side, which is investing, evaluating companies. Obviously, you've done a great job with Brighton Park. I think starting a growth equity firm probably is really hard, but most importantly, you guys have a lot of competition. But you've been able to raise 3 billion in 7 years. And I guess I was curious, what was kind of the hardest part about building your own brand from scratch? And I guess for you right now, currently, is like there an end goal for you?
Yeah. Yeah. So I think there are many things that are sort of difficult about it, but I'd say the two most important thing is, when you start a firm, you have this immense passion for excellence in
Mm,
everything that we do. And, as a founder, you set a very high bar for what you expect for people, for what you expect from yourself, and what you expect from your people. And I think in our case, the ability, I think of it as sort of being cognitively complex, which is, when you identify a potential investment opportunity, the ability to walk around at 360 degrees and understand the quality of the management team, the quality of the product, the value proposition it brings to customers, the competitive framework, how they price and package. Is it a global opportunity? And it's almost as if before you make up your mind on anything, the ability to talk to as many people who are knowledgeable about the circumstances in the company and the market and the environment, and wait to make up your mind till you sort of ingest all that, including the views and perspectives of your partners. I think so many times young people come to an investment opportunity and they kind of made up their mind. As soon as they meet the company, they say, "Wow, this is amazing," and
yeah.
they don't take the time to maybe study it in quite the right way and to
Mm,
sort of let different interactions and engagements with people in the ecosystem to help influence how a decision gets made. So that'll be the first thing. And then the second thing I'd say is just building a brand is hard. We started Brighton Park. Obviously, no one knew what the firm was,
yeah.
and so you rely a little bit on your own personal reputation and your experiences. And it just takes time to build it up brick by brick, experience by experience. But here we sit almost 8 years later, and I think most people know who we are and what we do, and I think we've tried to carve out a unique piece in the growth equity ecosystem, which has served us well.
And I guess I'm more curious on the part of operational experience. I think you mentioned in the podcast with RJ that being operational is very fundamental, especially whether that private equity or growth. I guess how do you guys utilize operating partners? How do you think investors should kind of look to operating advisors as well?
Yeah, I mean, one of the things I observed when I would chair the investment program at General Atlantic was that, ironically, when you talked or spoke to a great founder,
Yeah.
entrepreneur, they were most interested in having a former CEO or a former chief revenue officer or a former
Mm,
chief product officer sitting next to them. They wanted somebody who had the empathy and scar tissue and network of relationships that truly understood what it was like to be in their seat and how hard it is to build a high performance global company. And
yeah.
I think former founders and former entrepreneurs or former C-level execs exude those qualities and characteristics. And so increasingly, I found that's what the founders were interested in. So when we started Brighton Park, that was a core part of our ethos and a
Yeah.
core part of the human capital that we wanted to attract, is to say, hey, look, we're going to have a great group of professional investors. I think you still need that. But you also have, an equal size part of the team that is really driven by having the operational capabilities and skills and experiences to help on go to market, new
Mm.
products, globalization, things like that. And that's what we've tried to do.
No, and I guess taking all of that from, how you invest in obviously the software aspect of Brighton Park Capital, I want to jump into more of the topic that everyone has been talking about in the past year, and that would be the SaaS apocalypse versus the public versus private sectors. I think the SaaS apocalypse has been the dominant narrative of 2026. Mainly, you've seen Salesforce Workday, down 40% in the public markets in the last year. From your perspective, why is public SaaS getting crushed in
Yeah.
the AI wave?
Yeah, look, as I always say to people, the narrative is the narrative. There's a lot of people who make a lot of
Mm,
money creating that narrative and creating anxiety in the markets. And there's a lot of people talking their book on this topic. So it's the downside of the immediacy of media these days, where
yeah.
it's awfully easy, to kind of get to send that sort of sentiment out there, and all of a sudden it becomes, there's an echo chamber. We talk a lot
Yeah.
about this, about the Silicon Valley echo chamber, which is, everybody's talking to each other about the same things nonstop, and all of a sudden, because people are saying it, it makes it true. And I think
Yeah.
this is a moment in time to be pretty careful. The other observation I'd say is, look, the world, and having done this for a long time, the world, everyone wants to believe the world is ironically, as we're talking about software, the world's 0-1. It's
Yeah.
not. There are immense shades of gray, and it never is all or nothing. And I think, people want to believe like every existing software company is incredibly vulnerable, and that's just the furthest thing from the truth. I think for people to think that, companies like Workday and Salesforce and ServiceNow and CrowdStrike, these guys have been sitting on their hands for the last 3 years, not doing anything about sort of the AI opportunity is sort of woefully naive. And I think different companies will get through this in different ways. So there isn't a single answer for everyone. I think it's going to be a moment in time where leadership's going to matter a ton, and I think people are going to have to really double down on making the needed investments to either natively build new AI products or
Yeah.
heavily AI enable what they do. And I think those that get it right are going to do fine. Now, to answer your question more specifically, I do think there's elements around the edges of all these companies that make them more vulnerable for maybe no other reason that enterprise dollars are going to shift, right? Like
Mm.
people are going to say, hey, do I need to buy, replatform to Workday from what I have? Or do I want to take those dollars and spend it on new AI-led initiatives that are
Yeah.
going to make me operationally more efficient or make my workers more knowledgeable, that kind of thing. And I think dollars are quickly shifting. And I think that's part of what people, so it may be less about the vulnerability in a traditional sense and more about the vulnerability of dollars shifting elsewhere. And I think that has some validity to it.
Mark, I have to ask you this because you just said it, operationally efficient with AI and those models. And to me, in my opinion, I do think AI is a bit scary, especially how much it's innovated. But I think a lot of people also have fear of AI, what it's capable of doing. Some people don't embrace it. I guess from your perspective, um, how do we look at AI as something that's positive, given that, the whole idea of the job market, AI, but also we've seen like recent layoffs with Meta, but everyone talking about, oh, there's going to be new jobs with AI, prompt engineering, but we haven't really seen that in the last, few months, year, and I don't even know if that will happen the next year. So I was just curious, what your perspective there?
Yeah. Yeah. I do not subscribe to these dystopian views,
Yeah.
that AI is going to end all jobs. I will put a different stake in the ground that I actually um, find it is creating more work in many circumstances than eliminating
Mhm.
work. I look at
Yeah.
what we do, and one of these things these tools and models are able to do for us is to hone in on the exact questions, critical questions, the exact critical issues that
Right.
we need to run down. And it's forcing us to do a lot more work because we are so much more knowledgeable about
Right. Right.
exactly the right questions we have. So, like, I find our teams are having to work harder to answer
Yeah.
the very pointed, specific questions that we want to answer. So it's sort of adding to the system. And I think there's a lot of other examples like that. So look, that said, I think people are going to have to reinvent themselves. There's no question about that. I think, arguably a lot of the jobs that may be vulnerable short term are the jobs that got outsourced to places like India and the Philippines that were these, lesser skilled,
Yeah.
less judgmental, if this, then that type positions. And I think that's the stuff that's ripe for the agentic opportunity. And I think that's the first wave of things that are going to get displaced. So I think that'll be less impactful here in the US and arguably a little bit more impactful in places, such as those. But I think if people embrace the AI technologies and the tool set, and reinvent themselves around it, in my opinion, there's going to be plenty of opportunities. And the last thing I'd say, Logan, is I remember this exact debate when the internet got invented and e-commerce got invented.
Yeah.
Everybody in 1998 said every traditional retailer and every traditional business, whether you're in automotive or steel or aluminum or timber or whatever it is, like everything's going to move on to e-commerce and all the traditional companies are going to get wiped out and all the new e-commerce companies were going to that's where all the jobs are going to be and everybody else was going to get fired. And
Right.
that just turned out to be uncategorically true. There were people that suffered and, kind of ended up to be the dinosaurs, Sears and Kmart being two good examples, but
Hmm.
you could argue even those were not e-commerce related. Those were more
Right.
mismanagement. But there were companies like Walmart and Target and others that went through and have been phenomenal
Yeah.
successes, since that moment in time. So, again, don't get caught up in that narrative.
Yeah.
either important to pay attention to, but another part of the narrative.
No, 100%. There's definitely the pros and the cons. I guess when we go back to what you just mentioned with like the dot-com bubble, um, and if you were to compare it to just this AI bubble that everyone's been talking about, there's obviously was the hype of the dot-com era and then the crash. Was kind of curious, is there much of an actual difference, or have we seen this movie before? Is this kind of a repeated pattern from your eyes?
Yeah. So since 1990, there's been four major sort of technological transformations in
Mm,
sort of enterprise compute. The first was in the mid 90s when we went from sort of mid range and mainframe systems to client server.
mm,
The second was the invention of the internet in 1998. The third was all things mobility, which was sort of mid 2000s. The fourth was the movement to cloud based software, and the fifth is now what we have in AI. And the first four are completely different than the current AI opportunity in that each of those first four had everything to do with the way in which compute is consumed
mm,
and the pushing of compute capability to the edge, right? So if you think about it, it was mainframe, big machines to desktop equipment, mobility. The internet was sort of putting it up in the cloud and sort of
mm,
facilitating the way for all things mobility, which is you can compute on a tablet or a phone. And then the cloud was sort of putting the software not on prem but up in the cloud, so you could manage larger customers on a single code base. So all that had to do with edge computing, right? And stronger processors, in the end compute devices. AI is completely different from that, in that AI is the first time you bring true intelligence to the application layer, to the workflow layer, and that is truly transformative. And so for anybody to think it's, similar or, a parallel to, like, I think that is the exact wrong way. And I think that will lead people to make the wrong decisions, the wrong conclusions about the potential and the threats and the risks and the opportunities, around the AI opportunity. I mean, this is truly transformative in terms of, bringing an incredible amount of intelligence to even the smallest things. I think that part is going to transform it. And the last thing, which I think people are talking a little bit less about,
yeah.
is that there's a good argument to be made now that hardware is the new software. And I think
Yeah,
one of the
yeah.
most interesting things you're going to see is a new generation of companies that you now can bring true intelligence to very unintelligent
Mm,
devices. And I think we are like in the very, very top of the first inning on the potential. You're already seeing it in things like drones and or the early stages of pure
yeah,
robotics. But man, there are infinite use cases for how that's going to change, traditional
yeah.
hardware related items. So there's going to be and again, that's another huge area for job growth that like no
Yeah.
one's talking about. So like, I think that's where a lot of it is going to go.
Yeah, I think there's just so much hype around software that I agree. Like you have, the space era that's going to be coming soon, that AI compute in space, the hardware there that will be needed. Man, even Mark, I love AR and VR, and I will tell you, while yes, I think Apple had some downfalls with its AR VR tool, I think it's definitely going to be the next big thing. So I agree
Yeah.
with you. I agree with you. And then on the side of just taking into account everything that we talked about with software and AI, I'm really curious because you obviously work in the private sector, these private companies. Um, they raise billions of dollars, and they get valuations that are pretty unique. And I guess when you look at public comps where they're getting hit pretty hard, and both sides are pitching kind of the same story, at least the public ones that are embracing it. How do you think about true value when the two sides are pricing the same narrative differently, and which one do you think is actually wrong? Or I don't know if that's the correct term for it, but
Yeah, I mean, I think I'll give you the data
uh,
driven answer to that, and then I'll give you the instinctive or emotional answer to that, which
yeah.
probably is less valuable because this is ultimately a question about dollars and cents. But look, I think by the numbers, the public markets arguably have gotten it more right than the private
Mm,
markets. If you look at benchmark data that's produced on private markets and compare it to the public markets, over the last whatever 5, 6, 7 years, The public markets, using the S&P as a proxy is, have fared better. And now you can make the argument that it's fared better on the back of seven names,
Right.
which is entirely true. But nonetheless, like is fared better. And you'd say, okay, look, it's also completely liquid. It's
Mm,
hard to argue that strictly and from that as your frame of reference, that it's probably priced this better. And I think that's a testament to an important difference in the public markets, which is the winners are so much have so much more winning potential in terms of
yeah.
market valuations. Like if you would ask people, I don't know, 10, 15 years ago, would we ever see $1 trillion value company? Everybody said like, there's no chance of
Mm,
that. And, here you sit today, there's a bunch of them and there's more coming. And so that I think has been very, very, very different. The last thing I'd say is, look, there's a pendulum that swings between public and private markets.
mhm,
And I do think when you see something like AI come to the forefront, people know there's huge multiples of invested capital to be
yeah.
had by getting into these companies earlier in their gestation. Witness, some of the people and the success they'll have on SpaceX and others. And so I do think the area of the private markets is going to continue to attract large quantums of capital,
Mm.
especially around the opportunity that AI is going to offer.
Yeah. And I guess assuming most of your portcos or just general software companies are all embracing AI, I was more curious, like, what do you think the biggest challenges, whether that be the entrepreneurs, like, what are they facing right now in this AI era that you think people should be thinking a little bit more about?
Yeah. I think the two most important things, we counsel, companies on, is if you want to create a high potential company that, today is 20, 30, 40, 50 million of revenue and in the future can be two, three, four, 500. The number one thing is you got to build an outstanding team.
Mm,
That has never changed in our business. And I don't think it ever will change. You have got to, when you scale beyond 50 million of revenue, you cannot do that on the back of one or two people. I mean, there's some very small exceptions to that rule,
yeah.
but you've got to build a proper team. You got to have a great chief revenue officer. You've got to have a great chief product officer. You've got to have a great customer success person. You got to have somebody who's unbelievable at implementations. You got to have a pricing packaging person. Like you have to do a great CFO. You got to start to build team in Europe. So, those are the things you got to do. And I think the founders that get on that wagon quickly to say, this isn't about me and my legacy, it's about
Mm,
creating an outstanding team, end up on the right side of history. And the second thing, which is very different in today's environment, is you have to holistically embrace the potential of what AI has to offer in everything that you're doing. You have to, your software's got to be built on these code automation tools. It's got to be tested and deployed on these tools. You've got to do implementations in a heavily AI enabled way. You've got to do customer success and customer support in an AI enabled way. You've got to generate top of the funnel in an AI enabled way. There are so many areas of applicability of how AI can permeate your organization and make you better, more efficient with less people and have higher levels of customer satisfaction. So I think that holistic view of what AI has to offer, and it may sound super obvious,
mm.
but people are doing it for the first time. And so like it does require a different kind of thinking and mentality, and it probably underscores the importance of getting that team in place a little bit earlier if you're going to execute against this.
So then a follow-up to that would just be, just building these category defining software companies, as you mentioned, kind of going beyond maybe like 50 million ARR. I guess, what kind of differentiates the founders, the company? Do you think it's speed? Do you think it's speed? It seems like speed, especially in this era, is super important when you're getting your competitive mode or your competitive advantage. So I was curious there.
Yeah, it's velocity,
Yeah.
and everything. I mean, that is the number one, criteria in my mind when we look at a company, which is how fast do you go and how
Mm,
fast do you move. And you got to take risk, and you're probably going to make some mistakes along the way. But we think of it as AI velocity or software velocity. How quickly can you build products? What do your sprints look like? How do you make them feature risk rich? How do you get voice of the customer and what you're doing next, and also just voice of what nobody is saying they're doing. You're coming up with your
Sure.
own great ideas. It has everything to do with velocity, and that's in addition to two other things I talked about: building a team, and AI enabling everything. Velocity is right at the top of the list.
And it seems like a lot of venture investors, growth equity investors, they really do prioritize like at least, I worked at a VC firm and they always say, I really need to like believe the entrepreneur and their vision. I guess what kind of sells you on like an entrepreneur? Obviously they could have a good company, could have a good idea, they could have good financials, but like what really like sets someone apart? Like what do you see in kind of their
Yeah.
vision?
I, I would say EQ is at the top of the list.
Okay.
Great entrepreneurs got plenty of IQ,
Yeah,
and
sure.
you're probably find a way to sort them out, on that way. But so IQ is a plenty in this business.
Mm,
EQ much tougher to come by, and
mm,
I think that is, so cute, so key is, are you getting behind somebody who knows what he knows or what she knows and knows what they don't know? It's gonna be smart enough to pick up the phone and get, advice from you when that's an appropriate thing to do. And I'd say secondly is the ability to not try to do too much. I always
mm.
say, when you're growing and building a high growth, high potential company, it's just as important to make decisions about what you're not going to do as it is about what you are going to do. And I think there's, relatively few people who are great at that. And I think the
Yeah.
special entrepreneurs are really good about saying, and it's a bit of a clarity of thought, which also
Mm,
ties into this EQ, the ability to, in a very simplistic, well organized, well thought out way, explain to you the essence of the product, the essence of the value proposition, has tremendous clarity of thought as to what I'm building and how I'm going to build it. Is not trying to overextend or outkick their coverage. And, people saying we're going to do this and, 8 different things they're going to launch in the next, like, that shows somebody that, hasn't sort of thought it through.
mm.
And I think those, sort of EQ and clarity of thought and, making good decisions about what not to do. That's what we focus on.
That's a great take. And kind of just taking into account everything you've said, I definitely want to touch base on revenue durability. I think that's really important. Just software companies often metrics, growth equity investors look at. So I think with revenue durability used to be the bedrock of software valuation, high NRR, sticky contracts, predictable expansion. But with AI agents potentially compressing seat counts and customers pivoting to outcome-based pricing, how are you and your team underwriting durability today? And are there metrics you've stopped using or prioritize more?
Yeah. Yeah. I mean, we are definitely migrating to a different set of metrics, and which
Mm,
is not to suggest, the traditional metrics, are obsolete. They're just no longer sufficient. And I would say, like, one of the most important, we have a chart on this, but one of the most important things for people to understand is that when you were building a cloud-based software company, on average, it took you 60 months or 5 years to get to 30 million of revenue.
mm,
With these AI companies, they're getting to 30 million of revenue in less than 20 months. And that is a profound difference to what we're just talking about. So, like, traditional gross retention, net retention, like you used to get 4 or 5 years of the debt. Like, now you're barely getting a year. And in most cases, you're not even getting a year before you got to make a decision.
yeah.
These companies are growing up so fast. So, that's a perfect example of, a cornerstone metric that everybody who invests in software and AI would say, retention characteristics are everything. Well, guess what? You're not going to get the same retention data you used to get for a cloud-based, company. So, a lot of what we've migrated to, are metrics that are consistent with what I've taught. We're measuring software velocity. We're measuring
Mm,
percentage of code generated in an autonomous way. We're measuring the percentage of implementations that are, are they compressing implementation time? We're measuring, how support tickets, are they completely getting automated without a person having to touch them? We're measuring, the product feature functionality that's getting added to the product roadmap. How are they automating that process? So there's a whole bunch of other things. We're also measuring inference costs as a percentage of gross margin and a whole bunch of other things that are sort of in the guts of understanding how the financial circumstances change. But safe to say, there's going to be a very different set of metrics that are going to come to the fore that people are going to focus on.
And when you see a company like Anthropic and OpenAI just reportedly scaling revenue at a pace we've never seen before with any enterprise software company, does that break kind of the traditional growth equity playbook? Should we be valuing a dollar of AI native revenue the same as we valued a dollar of SaaS revenue, 2 to 3 years ago, or is it fundamentally a different asset?
Yeah, I mean, again, there's the static answer to that question, and then there's the forward-looking, answer to it. I think if you looked at it statically, there's no question the fully loaded gross margins of the frontier model companies are substantially below the gross margins of cloud-based software companies for the obvious reasons related to inference and infrastructure. I think the question to be asked and answered is, ultimately, do the frontier model companies end up looking more like a software company, or do they end up more looking like something like AWS? And I think, short to intermediate term, it's probably, between those two. I think you also have a circumstance where, a lot more of the economics of the software stack have gone into the chip layer. They're going into the infrastructure layer. They're going to end up in some of it's going to end up in the utility layer. So there's a lot of other mouths to feed that historically for cloud-based software companies have not been there. So it's hard to believe, intermediate term, like the margins are going to be anywhere near where the traditional software companies are, where some people, gross margins could be in the mid, even to the high 80s. Like that's just not going to happen for these kinds of companies. That said, there's a lot of plays in the playbook these guys are going to execute against in terms of small models, doing model routing, and other sort of techniques that they're going to bring down the inference costs, to make it more viable to sort of push up gross margins. And so, like I'd say, intermediate to longer term, which I define as sort of 3 to 6 years. I do think they'll push comfortably into the 60s, and it'll depend a little bit on chip pricing and infrastructure, data center build out. But I think there's a reasonable argument that they have line of sight to get there.
No, 100%. And kind of just since we've already been talking about models and LLM so much, one of the main things, the topics that you like to talk about is open source, according to your bio on the website. So I was curious the gap between open source models and the closed frontiers, like the open AIs of the world, has compressed dramatically over the past few years, and enterprise adoption of open weight models is accelerating. Do you see open source as a real threat to the moats of OpenAI and Anthropic, or is the value migrating up the stack to the application layers you mentioned, the proprietary data? What's your outlook?
Yeah. So a little bit of a difference between open weight and open source. I think open weight, let me focus on that because I think that is the one that arguably will have the bigger impact on Anthropic and OpenAI, because I think that if you look at where we are in the AI journey, up until now, we've had this unbridled enthusiasm for experimentation. It's kind of like the bright shiny object or the new toy, and everybody wants to play with it in every imaginable way, with probably not a lot of regard to cost. And now, as people think about really bringing it into production, in more heavy use cases, everybody's figuring out, oh my God, this is really expensive, or a lot more expensive than I thought it was going to be. And so now the cost containment phenomenon is finally starting to come to the fore. You go talk to big enterprises, and this is the number one thing they're focused on, which is, how do we economically and viably roll this out in a sound way that we can sustain, the costs relative to the ROI. And that's where these open model companies are going to play more of a role. And I think the other areas, and areas like financial services and healthcare and a bunch of others, they're going to want to, have their data sort of in a locked up environment. They're going to want to do
Mm.
more training of the models. They're going to want a more economically viable path to a model that can sustain itself. And so, they're probably not at the same quality of Anthropic and OpenAI, but I think you'll see a lot more pressure in that way. Again, short to intermediate term, there's so much market for everybody to get in terms of experimentation. I think everybody's going to do really well, but I do think they're going to become viable alternatives for a whole bunch of use cases.
Hmm. No, that's an interesting perspective. And Mark, I kind of wanted just to end with some more rapid fire questions. And partly wanted to begin with more on just the Brighton Park philosophy, investing philosophy. But what does enough kind of look like for a Brighton Park fund, and what's your actual playbook? You mentioned with RJ, just kind of facing adversity when you are potentially getting like a one or a two time exit on an investment. I guess, do you double down? Do you restructure? Do you sell? How do you approach it?
Yeah. So I would say that maybe three observations on, what is enough. First, I would say every company has a natural life cycle. And for some companies, that life cycle, maybe 3 to 7 years. And for other companies, they may stand the test of time and go on for 20, 30, 40 years.
Mm,
I generally think you've got to look at every investment for what it is and what the company is and be sort of open-minded and be willing to take the counsel of others around you. Sometimes you can get blinded if you're specifically in the middle of it
yeah.
to figure out what that life cycle is. The second thing is, I think you always want to pay attention to leaving enough for the next owner to feel like there's real upside for them. I think
Mm,
one of the mistakes people make in our business is you take it to, the almost the end state.
yeah.
And then people look at it and say, I think these guys have maxed out on market share. I don't see an obvious next process or next product. The margins are already 35%, and like I'm not going to be able to push margins. So like there isn't enough left for the next guy. And I think sometimes, investment firms shoot themselves in a little bit of the foot of not leaving a bid on the table or a bunch on the table for the next guy to get excited to lean into a price that is ultimately compelling. And the last thing, which may be the most important, is it's critical to remember that companies are bought and not sold, especially software companies and AI companies.
Mm,
It is generally the case that the strategic buyers out there pay very close attention to companies they're interested in or capabilities they need, and they're typically knocking on the door of the best companies, probably well in advance of when those companies are ready to sell. And if you're not getting those inbound inquiries, you're probably going to have a tougher time selling your companies. And I think that's one of the big changes in an AI world. I think a lot of the capital that's in the ground, I think people are going to have, a tougher set of circumstances on the way out when they think, oh, we can sell everything. Well,
yeah.
guess what? I think, the bar to get sold just went up a whole bunch, based on, do you have a real AI future? Are you going to survive in an AI world, et cetera?
Mark, sorry to go back to your first point. I guess when you're making an investment, why is it important to leave some of that market value to said someone else? I'm just looking at it like, well, I would want to get the most value and kind of be as efficient as possible, but
Yeah.
just curious there.
Yeah, because I think the price someone's willing to pay you is, highly correlated to what they think their opportunity is
Mm,
once they own the business. So, if you've, dramatically increased prices over the 5, 6, 7 years you've owned it, and, you've gone from 10% market share to 35% market share, and you've
right.
optimized the margins to 40%, then the next guy says, well, I, probably can't lift prices. These guys have, hammered the customer for 7 years in a row with 8% price increases. Yeah, the
Yep.
margins are already optimized. I'm probably not going to increase my share much beyond where it is.
Yep.
There isn't a bunch of bolt-ons to do. You've already rolled up to 2, 3 things that make sense to add. You know what I mean? Like, so I think it's that thing that they're still going to want to, they may still want to buy it, but instead of paying you, a 20 multiple, they may say, I'm going to pay you a 12 multiple. So,
Mm,
question is, if would you have been better off selling it 2 years ago with a little bit less earnings where they would have said, hey, I'm leaning into, 5 value creation tools that I feel like still have some upside. So it's a little bit, I know it's hard to understand that, but
Yeah, no, I get. I
it's
guess I kind of get
important,
it. Yeah,
it's important, not to be too great, yeah, I don't say it,
have
not
a
to be
sweet
greedy.
spot.
Like,
Yeah.
yeah, I just like, you've had it for a defined period of time. You've done well with it. Sell it at a moment, take it at the flood, sell it when it's still got some decent upside to someone. I think you'll get better prices.
Okay, that makes more sense. And this is an interesting question because I've gotten asked this by just a few friends. If you were Mark, if you were to write a check into either OpenAI or Anthropic today at their current valuations, also just based on what you've used, no hedging, no both, which one are you backing and why?
Yeah. So I'm going to give you two answers to this one, and I do not give investment advice. It's one thing
Yes, of course.
I've learned. I'm okay at the private markets. I'm not sure I'm that good at the public markets, but um, I would say Anthropic, and not for the obvious reason because obviously they get tremendous momentum against what OpenAI is doing, but I look at it much more from a management perspective. I think, unfortunately, if you look at the revolving door of leadership at OpenAI and what's happened,
Hmm.
and and most recently the fight with
Yeah.
Musk about what they're allowed to do, and like to not think that causes massive amounts of distraction when you're losing super talented people and you're going through all these exogenous shocks to the system. It does take away from a lot of things in these kinds of companies that are just so important. I think each of these companies are going to do exceptionally well,
Mm.
but I think Anthropic has done a very nice job of building the team, building the global capabilities, being in the spotlight when it's made sense to, but arguably for the right reasons. It seems like OpenAI is there as much for the wrong reasons
Yeah.
these days. So I do give these guys a bit of the edge. The second observation I'd make is, look, the better trade, in my opinion, may be in China, in terms of again, something people aren't focused on because China is not going to let either of these companies be successful
Yeah.
in that market. They've never let any of the U.S. tech platforms be successful there, and they sure aren't going to start with Anthropic or OpenAI. They are going to build their own ecosystem, in this market. And I think there's some very interesting things, to be done, in that market based on, a handful of the companies that have a vested interest, in the, especially as, they've approached it in a much more open way in terms of, opening up, these models and sort of being an API first, type opportunity where, they're building the infrastructure layer for people to
Right.
use it, in a much more seamless way. So I think there's probably some very good things to be done in that market that people arguably are paying less attention to.
100%. And the last question for you, Mark, is a lot of my listeners are young bankers, consultants trying to break into growth equity. What separates the associates who eventually make partner to those who don't? In a world where entry-level analyst work is being automated, what skills should they be building right now to make themselves
Yeah.
unreplaceable?
Yeah, so I just did a presentation for our team on Monday on this exact
Oh,
topic.
nice.
So it is top of mind. So this is one I feel like I've thought through. And we'll try to, we usually do a webinar for people who are interested in coming to growth equity, and maybe I'll share it with everybody to go through this in more detail. But look, you're exactly right that you think about what analysts and associates have been asked to do when they join us, has largely been market mapping exercise, doing core research, organizing material, writing investment memos, doing financial models, doing customer cubes. And you are exactly right. Like all of that stuff over, it's currently getting done now, but certainly it'll run its path to completion in the next 6 to 9 months, where 80 to 90% of that's going to get done by a series of AI tools. So it is going to free up a massive amount of time, for people. And so what I say to people is it's going to free up a whole bunch of your time to do other
Mhm.
things that are more valuable. And what I've said to our team is, number one is you've got to be a deep AI expert in terms of the tools and technologies. Like one of the things we say to our team is, you got to look through a lens to say, like, how many agents are you going to have working for you? And, not only should be yourself, but you should be able to execute in a way which you have like 10 or 15 people working for you. And so that is what we're trying to do, is to build this agent-based workforce that just dramatically enables our people to be more productive. It's going to allow you and force you to generate more differentiated insights. So we're going to expect, more differentiated thinking, more differentiated insights. We're going to expect you to come up and identify more second order risks, not the obvious stuff. That's sort of the first order. Everybody can see that. What sits underneath that we've got to pay attention to and analyze. You've got to be able to synthesize better. You got to be able to ask better questions. And most importantly, you are going to have to be a prodigious networker. Like this business, the part of this business that will never change is the best investors are just like the entrepreneurs themselves. They are prodigious networkers. They love to be in front of people. They love to build relationships. They love to meet people they haven't met before and connect with people that are going to lead to ideas, investment hypotheses, new entrepreneurs, new investment opportunities. And it's going to have to free up your time. You're going to have to be great at that, and engaging with people. And so, all that desk work sitting in front of a screen, like that's all going to quickly go away. And the best people we're going to be looking for are, the extroverts that, really can hit above their weight class in terms of being able to engage a 30 or 40 or 50-year-old founder, even though they're 22. Can you ask the right questions and make the right observations, and carry a dialogue where they say, even this is a very young person, like they're damn smart and they're asking the right questions and they know what I'm trying to do.
100%. Mark, this was an awesome conversation. Thank you so much for your time, and it was a pleasure having you on. Thank you.
Great. Thank you, Logan. Be good.